All right, let's talk Crown Castle. Their latest earnings call was frankly a pretty big deal. You've got a new CEO at the helm, a massive strategic pivot, and the company is basically redrawing its own map. So we're going to break down what this huge shift really means for the stock and for investors.
First things first, let's look at the bottom line. Crown Castle posted a really solid beat. Their official GAAP earnings per share came in at 74 cents, a full 14 cents higher than what Wall Street analysts were penciling in. That's a strong beat, no two ways about it. But, and this is a big but, here's where things get kinda weird. While they were crushing it on profit, their revenue actually cratered, dropping 35% compared to last year, a huge, huge decline that seems to fly in the face of that great earnings number. So what gives, right? How on earth can a company beat profit estimates that handily while its sales are falling off a cliff? Well, that's the big mystery we're going to solve here. And the answer has everything to do with a major change in strategy.
Okay, let's start by digging into those headline numbers because they are absolutely sending a mixed signal. To really get what's happening, you have to look a little deeper than just the surface level figures.
Okay, so what's really going on with this slide is mostly an accounting story. You see those drops in revenue and EBITDA? Well, that's because Crown Castle is in the process of selling its entire fiber business. So for accounting purposes, all that revenue gets moved into something called discontinued operations. It's basically taken off the top line. The numbers you really want to look at for the new, leaner company are things like GAAP EPS and especially AFFO per share. That's a critical cash flow metric for these guys. And on those fronts, they both beat expectations. So the takeaway is, the core business that's left is actually doing better than people thought.
And this is the number management really wants you to focus on. If you pull out all the noise from T-Mobile shutting down the old Sprint network, the actual core tower business grew by 5.2%. This is the figure they kept coming back to on the call, holding it up as proof that demand for their main assets is still super healthy.
Which brings us to the absolute heart of the matter. The company is intentionally pivoting to a tower-only strategy. And look, this isn't just some financial shuffle. This is a fundamental redefinition of what Crown Castle is and what it wants to be.
In his very first earnings call as the new CEO, Chris Hillbrandt basically gave the company its new mission statement with this quote: "The game plan is all about simplification. They want to focus only on the U.S. tower market and be the absolute best operator in that one space. They're getting rid of the fiber business because, frankly, it was complicated, it ate up a ton of cash, and they believe it was hiding the real value of their core tower portfolio." And here's the nuts and bolts of how they're pulling it off. They're selling the fiber and small cell businesses for a cool $8.5 billion to EQT and Zayo. And they have a very clear plan for that cash infusion. They're going to pay down debt to make their balance sheet stronger, and they're launching a massive $3 billion share buyback, which is a direct way to return a ton of that cash right back to shareholders.
So, with a much simpler, leaner business, the new CEO is turning his attention inward. The new priorities are all about getting their own house in order. They're investing in better data, automating old-school processes, and just generally looking for efficiencies everywhere. The whole idea is to squeeze as much profit as possible out of the tower business that remains.
Okay, so that's the new strategy, but what does the future actually look like now? Well, the company's guidance and the Q&A with analysts gave us some really important clues about what's coming next.
You know, talk is cheap, but management actually put its money where its mouth is by raising their outlook for the full year. They nudged up their forecasts for site rental revenues, adjusted EBITDA, and that all-important AFFO number. It's a pretty clear signal that they're confident this new, leaner approach is already starting to work.
The analyst Q&A was really revealing. It basically circled around three big things. One, analysts wanted to know how they'd grow with their existing assets, and management kept talking about a back-to-basics approach. Two, they got asked about the drama with the Dish and EchoStar contract, and the CEO was very blunt, saying simply, "We expect to be paid." And three, that theme of operational efficiency just kept coming up over and over again. So, you've got management laying out this clear, confident plan. They raised their guidance. But the big question is, did Wall Street actually buy it? And the answer, for now, seems to be a resounding maybe, which brings us to the market's pretty muted reaction.
Now, to be clear, people were definitely paying attention. You can see here the trading volume jumped in a big way on the day of the call, from about 1.8 million shares to over 2.6 million. So the story was getting out there. The interest was real. But all that interest didn't really move the stock price much, and that's the core issue right now.
You have this disconnect. Management is pitching this great story of a focused, efficient, growing tower company, but the market's verdict is pretty clear. This is a show-me story. Investors have heard the plan, and now they're sitting back with their arms crossed, waiting to see them actually pull it off before they're willing to bid up the stock.
So what does this all mean for the stock going forward? Where do we go from here? Well, here's our take on what to watch for as we head toward the next earnings call. We're kicking things off with a market perform rating. Look, the strategy makes a lot of sense, and that core tower business seems to be in good shape, but the stock's reaction tells you everything you need to know. The market isn't ready to pay a premium for the plan just yet. They need to see the results. So until the company really proves it can execute, we expect the stock to pretty much move in line with the overall market.
And here are the specific things we're going to be watching like a hawk. These are the proof points the market needs. First, any news on the fiber deal closing, which is supposed to happen in the first half of 2026. Second, we need to see that churn from the Sprint shutdown start to level off. And finally, we'll be looking for any big new leasing deals with the major carriers that point to strong demand for 2026.
And this brings us to our trade idea, and of course, this is not financial advice. Right now, the market is pricing in the risk that this plan might not work out perfectly. So if you're a believer, if you think management is going to nail this tower-only strategy, one interesting way to play it could be with long-dated call options, options that expire after that fiber deal is set to close in mid-2026. The thinking is, if the deal closes without a hitch and those efficiencies start showing up on the bottom line, the stock could get a major re-rating. Basically, investors will be willing to pay more for it once all that uncertainty is gone. It's a way to get leveraged exposure to that potential outcome.
This is not financial advice.